All right, hi there. Thanks everyone for joining us today. This is Rob Hanna of Quantifiable Edges, also of Capital Advisors 360. And with me today I have Ali Pashaei. And Ali is someone I've known for quite a while, several years. We've interacted back and forth, and we've talked about doing this for, I don't know how long, Ali. It's been like a year, where we were thinking, hey, let's have a webinar, and so I'm glad we were finally able to get it organized. And Ali's got a bunch of great options trading experience and ideas, and I'm excited to be able to talk to you today. So welcome, Ali.
Good to be here, Rob.
Before we get going, we've got some disclaimer slides I think we've got to deal with, right? So let me just show, this is mine. Basic ideas here are that it doesn't necessarily, the methods, techniques presented aren't going to necessarily result in gains. You have losses too when you trade. Anyone that's traded should know that. This is not individual investment advice. We're not recommending any securities, any strategies for anyone. The stuff we talk about is not suitable for everybody. So talk to your advisor or tax consultant if you have one before you get into new type strategies. Also, we will talk a little bit about some hypothetical performance. Backtesting and hypothetical performance have their limitations, as does real performance. Just because someone returned 30% last year doesn't mean they'll return 30% every year. I've never had 2 years back to back that have been exactly the same, and I'm sure you probably haven't either, Ali.
It's very correct.
So that's basically my disclaimer. Here's Ali. Is there anything you want to say about yours? You just want to let people look at it quickly?
Yeah, I just want to say that I'm not an advisor. I'm an independent trader who trades my own money and family money, and nothing here should be considered investment advice. Everything is purely for educational purposes, and as Rob indicated, markets change all the time. So whatever strategies or concepts we discuss that may have worked in the past doesn't necessarily mean it will translate the same into the future. So everyone needs to do their own analysis and figure out whether certain strategies are right for them or not.
Well said. All right. Let's get to the fun stuff. Why don't we start with just a little introduction about you? Let's go back a ways. How did you get into trading to start with? Was it something that you were exposed to as a kid that you always knew you wanted to do, or is it something that came on later in life? Or
yeah, a little later, at early college years, a friend of mine came up to me and say, "Hey, there's these things called stocks. We should buy them. They're going up." Said, okay, neither of us knew much about it. We decided to scrape up some money, a couple of college kids, borrowed some from our parents, and I said, so what are we buying? He said, well, the library we were going to, it got all these PCs, and they're all running a operating system called DOS, and it's being produced by a little company called Microsoft. I think this company is going to do great. So
that's not a bad first stock to buy.
No, it's not. So neither one of us knew much. So back then, nothing was online. We opened an account, called our brokers up and said, we like to buy these shares. I recall at the time they were going for around 74 or so. So we bought them, 50-50. The broker calls us up 2 days later saying, well, the stock is around 72. Do you want to buy some more? We looked at each other and we said, sure. So we borrowed a little more, added a little more to the position. And then within a week, Microsoft was trading, I think, under 30.
Oh, my God.
As it happens, it was the 87 crash. So we literally got into the market about a week or so before the 87 crash. And
that's a quick lesson.
That's a very quick lesson. Of all the days and time we could have picked, right? It's right before then. So I was just praying I get my money back. He said, "Do you want to buy some more?" I said, "No way. I just want my money back." And I waited a year. It came to about break even, and I sold.
Okay.
So that was my first experience, believe it or not. My second one was the same person comes to me at around 99 and says, "I've been trading stocks and I've been doing well. We should get involved again."
99.
I said, no, 99.
you skipped the run up in the 90s, right?
Yep. You see how I got a perfect timing here, right?
Yeah.
Yeah. So, and he's been convincing his family to put in family money into it and all that. So I said, I don't know. And I'm looking around. Everybody else around me seems to be making money with stocks. I said, okay, fine. By then I had more money, so I put in more money, and we all know what happened in 2000. I was invested in a lot of the tech companies. Many of them never came back. And I think it was right in 2000, end of 2000, where I said, you know what, this ain't working. I got to learn this stuff before committing any more capital. So that's where I started getting serious about investing in trading. It was back in 2000, 2001.
Okay. So those initial forays were basically just looking for ideas of things to invest in. It wasn't any kind of analysis beyond that, right? It was
no.
Okay.
No. It was looking around, seeing what other people are buying and buying the same things, or throwing darts at the board. So.
Right. Okay. So then, what did you do at that point? Did you go start reading up on trading? Did you? What was your next step? I guess as far as
Yeah, well, in 2001, I said, you know what, I got to get serious. Walked into a bookstore, started going through books. I encountered these instruments called options, read a little bit about them, and it immediately clicked with me. I was very much attracted to the aspect that you could limit risk. And being burned twice, second time much bigger than the first time, I said, this is it for me. This way I can, have an opinion about the market, yet at the same time have a way of managing my risk. And I was also very much attracted to all the different things you could do with them. It wasn't a binary, either you're long or short. It was all sorts of other things you could do with them. So I started really, really digging deep into them. 2001, took some courses. And by the end of that, I was, towards the end of 2001 and early 2002, I was trading multi-legged positions, anything from simple puts and calls to trades that involve 4, 6, 8 legs to them, if you will.
Okay, so like a butterfly or a condor with like the 4 legs there, and then you'd get even a little bit more complex.
Yeah. I mean, one of my trades was to basically put and believe it or not, some of these variations I still do, but for instance, trade a butterfly above the market and maybe put a trade below it, like a calendar at the time. That's what I was doing. Were 2 butterflies, one below, one above, and kind of, lean them one way or another. So. But I was also doing very simple trades, just buying puts and calls and simpler trades as well. And 2002 was actually a very good year for me. It was my initial experience, and I learned how to trade, but it's mostly a down market. So I got most of my experience as the market was going down.
So at that point, were you making money selling volatility because there was so much vol, like options were priced real high, or were you making money directionally?
Most of my money in 2002 was made directionally,
Okay.
owning long puts or put spreads to the downside. I was involved in selling some premium as well, but not as much. Again, because I was very, and I still am, very risk averse. I sell premium, don't get me wrong. I do it a lot, but I'm doing it in a very careful way, in a defined way. But yeah, most of my profits in 2002 came from just being bearish on the market, either call credit spreads, long puts, or long put spreads.
Okay.
Yeah.
So I mean, your perspective is interesting from the fact that you came into options after, two big disaster markets. And I find it interesting because option traders today, right, there's been a lot of people that have become option traders in the last few years. And we see that through options volume, right? And I think most of them have not done it because they're trying to manage the risk. I think a lot of the retail option traders, or the new ones these days, are doing it so they can lever up.
Yes.
Right? So, because that's kind of the two ways that people look to utilize options, right? Either manage risk or increase leverage, correct?
Yeah, I mean, that's the primary way people get involved. It's to use either leverage or define risk. And some other folks get involved because they're, and this may come a little bit later in the stages of their progression in learning options, is that you can also formulate a very specific opinion about the market. For instance, you might say that I think the market may go up a little bit and volatility may come down. And I think there's, if we do go up, I think, let's say there's the upside is fairly limited, and so we may kind of drift upwards, right? So you could customize your opinion or customize your trade structure based on very specific opinions with regards to price, magnitude of the move, and volatility, and that's another way of doing it too.
Okay. And I got to think a lot of people that initially enter the options world with the idea of, hey, I can use these as leverage. I don't have to, put as much of my account in as I would with a stock, quickly learn the downside of using a lot of leverage. And if they don't learn to use options to manage risk pretty quickly, they end up out of business.
Very true, and I know some of those people. I have some friends that last year got involved, and they saw their little accounts go up 400, 500, 600%, thinking it's an easy game. Most of them that I talk to have pretty much lost all of that. They simply don't understand that if you could take a account and get 1,000% on it within a few months, that it can work both ways,
Right.
So,
yep.
So, but it's a lesson a lot of people learn. I'm just glad I learned it early on, and not later.
Yeah, it's better learning it with small money than big money, right?
Exactly.
And with your own money rather than other people's money too.
Yes.
Right. So, learning it in 1987 when you're trading your own money and maybe a little bit borrowed from the folks is a lot better than when you're managing your own account and family money.
Absolutely.
That's when losses hurt more. You don't want to lose mom, dad, and sister, brother, and all their money too.
That's right.
Okay, so sorry to interrupt. So you had a great year back in 2002, and then let's kind of continue. At this point, you're still trading part-time, right?
Yeah, I'm still part-time, and 2002 did great. However, since I'd learned to mostly trade options on the downside, I had no awareness or understanding of how to trade the upside. So 2003 comes and the market's rising. So 2003 was actually a losing year for me. Not a huge loss, small loss relatively, but you know, I'm still learning. Then I realized, aha, there's two sides to the market, and maybe even three. So there's up, down, and sideways. So slowly I start getting better and, you know, getting a better feel for the market. I kept studying. I kept learning. One of my biggest things has always been to assimilate information, basically learn different concepts from different folks, but mold it into my own thinking and trading style. So, and as years went by, and luckily, knock on wood, either luck or whatever you may call it, you know, my worst losing experience was that 2000. Actually, well, 87 in terms of percentage, but then 2000 in terms of the amount of money. But since then, and I got involved in option, my drawdowns have been very small. Even 2008, at a very small drawdown. So I didn't make money. I just lost very little. So, you know, I started getting more and more consistent, profitable, and that's been my goal. And then slowly transition to just doing this full time.
Okay, and then how did options in practice come about? Like, how long have you had the site? And then I think, did you start mentoring people before you even put the site up?
Yeah. We had some before COVID. We had some local investment groups. We were meeting on a monthly basis, and I've always had, my background is technology and teaching, so I've always enjoyed interacting with people teaching. So, you know, that came as a way for me to share information with others and learn from others. Then slowly more and more people started asking for more personalized mentoring, if you will. So I started doing some one-on-one mentoring. I didn't have a website, and then did that, and then slowly that turned into more of a group coaching. And actually, my website, I didn't put this up until about a year ago. I was actually hosting my material, my mentoring, and some of my classes through another website. But this is a fairly new, and it's right now the work I'm doing. It's mostly with a group of more experienced option traders. And it's a sort of a group coaching. But I am planning to expand on it. Maybe you know, create some material that's also applicable to people that are more at the beginner to intermediate, or I would say intermediate. But it's the site is a new thing for me.
Okay. Well, you brought a bunch of slides here, so I want to get into some of them. We want to talk, you know, about using options for directional trades, like the title says here. I think we've got kind of a broad audience with us. So you were kind enough to set up a few kind of simplistic description slides here, and maybe it'd be a good idea to just kind of go over a few definitions here of the you know the primary components of option pricing, so that people know what we're talking about when we say delta or vega or whatever.
Yeah, sure. Yeah, so we can go through these quickly. Again, I don't know how familiar people are with options, but there's different things or components that go into price of an option. But the primary three things to remember is direction, and that's typically when you see an option has what's called a delta. It's showing you how the price of the option is going to change as the stock goes up and down. There's the aspect of time. If you're selling an option, it decays, so it works for you. If you're buying an option, as it decays, it works against you because options have a limited time. And that aspect of it is measured by a Greek called theta. And then there's volatility that also impacts the price of the options. As volatility goes up, options get more expensive, and as volatility comes down, they get cheaper, and that's measured by a Greek called vega. And each of those have a very specific definition as what they're measuring. But these are the kind of three things to think about when you're trading any kind of an option position.
Okay. And there's others as well that we're not going to get into here, right? The secondary ones like row and things I hardly think about.
Yeah, row, it's based on interest rates and
so maybe that's something we need to think about in the future if inflation keeps
yeah, exactly.
keeps going up and up. Right?
Yeah.
So again here. You want to walk us through this a little bit, what you're thinking about when you're a buyer of an option versus a seller of an option?
Yeah. So, this is a very common thing you hear out there where people, there's two camps of people. There's option buyers and sellers. Option buyers will tell you that option sellers are wrong. They're picking up pennies in front of a train. And option sellers will tell you that the buyers are wrong. They're just gamblers. But essentially, neither one of those camps is right. There's no such thing as option selling is always better than buying or buying is always better than selling. It all depends on market behavior. And in fact, if one camp was right and the other was wrong, option market wouldn't exist because big funds would come in and do the opposite and they would dwarf the retail traders. So,
right.
But in reality, as an option buyer, what you want is stock movement. You don't want a stock to stay still. If you're buying it and you ideally want a quick move. And you also want to see an increase or at least no decline in implied volatility. Implied volatility is basically the volatility component within the option prices. And as an option
that's kind of your ideal scenario there, right? Because most of the time, if you buy a call and it goes in your direction, volatility will go down some, right?
In some assets, that's true. At times, for instance, for indices, volatility is inversely correlated usually,
right.
as you know. So if a stock goes up, typically vol comes down, vice versa. Now, with stocks or commodities, it may work differently. You may get moves that are big enough that would actually increase the volatility to the upside. So
you're talking about like with meme stocks, right? Like those last year you saw GameStop rocketing and volatility going through the roof at the same time. Is that an example?
That's an example. And, whatever is moving fast, let me put it this way. If Tesla is moving up strongly, you're going to see an increase in volatility as it's going up.
Okay.
There are other things that would cause implied volatility to go up, even if the stock's not moving much. That's something like if its earnings is approaching. So the vol of the options that are after the earning, near the earning time, but a little bit after, are increasing typically rapidly into earnings. So. There's other things that impact, and also it also depends on where you buy the option, right? So that's also important, whether you're buying it out of the money, at the money, or in the money, whether you can somewhat cancel out or reduce the impact of volatility if you just want to purely focus on direction.
Okay. And then option selling. Kind of, it's basically the opposite of the buying there.
It's the opposite, meaning that if you're a seller of an option, you want less movement. That will benefit you. You want, if there is movement, you want it to move slow, and you also want volatility to decline or at least not increase during the period that you're short those options.
Okay. All right. If it's all right, we'll talk a little bit. You mentioned these are some ways to get long or get short, and this is I'm going to want to dig into these a little bit, but I think maybe if you I'll let you talk it through, and then you've got, maybe I'll save some of my questions here for a few slides later, like, because you've got some real good stuff coming up by now.
Yeah. So just to be clear, there are many ways of configuring options. You have puts and calls, you can buy them or sell them, and you can combine them in so many ways. So the 5 ways I've outlined here for worth getting long or short, it's not the complete list.
Right, it's 5 out of 1,005.
Exactly.
Okay.
But this is the most typical and straightforward way of doing it. Any other way that you end up doing it, you're also bringing in other aspects, or you're speculating in other ways as well, which could be great. For instance, you could say, I think the stock's going to go up, but not that much. But just to put it in basic terms, if you're bullish, you can either buy a call, you can sell a put. Both of those are bullish positions. You can sell a put spread, so you're basically selling a put, but then you're buying a put underneath it for protection. So that's a kind of what's called a defined risk vertical spread. Or you can buy a call spread. You can buy a call and sell a higher call against it. You're creating what's called a call vertical spread. Or you can combine puts and calls. For instance, you could, sell a put spread underneath the market and buy a call or a call spread above it. And some traders like to do that because it's kind of giving them a little bit of the both premium selling and buying combined. And
right. So if you're doing that, you get you get some cash up front. If it goes in your direction a little bit, you're paying for the call that you just bought. And if it goes in your direction a lot, right, then that call becomes worth quite a bit more. Is that the idea?
Yeah, exactly. I mean, it's giving you a way to reduce your initial cost. So if you're buying a call, you're paying a premium. And if you're selling a put or put spread against it, you're reducing the out-of-the-money cost. Now, the cost and risk are 2 different things. If I'm actually buying a call, let's say I pay, $4 to buy a call. If I sell a put spread against it, I may reduce the cost of that call to $2. Now, some people may look at that and say, well, that's even better. Why don't we reduce the cost to 0? Can we do that? Yes, we can. We can sell more put spreads. But that doesn't necessarily mean I'm reducing my risk. I'm just reducing my initial cost. So the idea of a credit versus debit, sometimes it gets confused with good versus bad, and it's not true. Just because you're getting a credit doesn't necessarily automatically mean profit. But yes, it does allow you to the benefit of buying a call or a call spread and then financing it with the sale of a put spread underneath is that if the stock doesn't move up quickly or it just stagnates, you end up losing less as it lingers in the middle. Remember, we said as a call buyer or a call spread buyer, you want the stock to move quickly. Well, by selling a put spread underneath it is a way to kind of hedge that a bit and say if the stock doesn't move up quickly and just kind of goes sideways, at least I'm not going to lose as much, or I might even make a little bit of money there.
Right. But you are taking on more total risk, right? Because you got your whatever you paid for the call, with $4 for the call, and then if the price ends up closing below the put spread,
exactly,
you're gonna lose on that as well.
You're taking additional risk there, exactly. And one way to do that is to say, look, I was going to go buy 10 calls, call it $4,000. Instead of buying 10 calls, I'm just going to go buy 3 or 4 or 5 and take the rest of my risk that I'm willing to take, which is $4K, and convert it into a put spread. So you can end up in the market with the same amount of risk. You're just going to own fewer calls total.
Okay. Let's assume people get that, because I think you've explained it very well. And then maybe we'll talk in details about some concepts of kinds of short-term trades. But let me let you go through your research that you shared here.
Yeah.
Can you describe this chart and what's going on here? And
Yeah, this was back in 2010, and me and a group of friends, we said, let's see if we could take a directional system, a mechanical quantified directional system, and we wonder how it will work with options. So, for instance, if I would buy a call and a put, is it going to roughly be same as if we're trading the underlying? Are we going to get the same benefits, if you will, right? So there's a lot of theory in options that there's your deltas and this and that, and there's basically what's called the Black-Scholes model, which is telling you how the option is going to behave as the stock moves, volatility changes. But we need to really test it out to see if it works in reality or not. So what we did was we took a relatively simple mean reversion system that was published by Larry Connor, and he was basically using a 2-period RSI and buying the dips when RSI went under 30 and traded or stayed there for 2 days in a row. And then we would scale in. We would start with maybe one contract, or let's just say if we were trading 100 shares, we would be 10 shares. And then the lower the price went, we scaled in, we increased the size. So we went from being long 10 shares to adding another 20, to adding another 30, to adding another 40 with a total of 100 shares. And then the exit was simply a bounce with RSI2, I think, going over 70. So it's a pretty straightforward system. And then
I imagine the average time in the trades would be a week or so?
Yeah, that was about right, about being, on average, being in the trade for about a week. And then trading on the bullish side, if it was above the 200-day average and below 200, we would trade the bearish side, meaning, going short. And what we did was...
When you went short, you were going short when the RSI got real high?
Yes, exactly.
Okay.
So basically the rules were flipped.
Okay.
Looking at RSI either below 30 to go long or above 70 to go short. Yeah.
Okay.
So, testing it with the stock was not difficult. We had, I had software that I was using back then that I could run the tests and see what the results were. And this is the result of that system on the stock itself, going from 2005 until 10. So this was a 5-year period. But the nice thing about this time period was that it included both a bull market, bear market, and a sideways choppy market. So we got to see how the system behaves in 3 different market conditions. So this was our baseline, if you will. This was our actual stock. So then the project was, well, what would happen if instead of the stock, we bought a call? Or we bought a call or put versus, let's say, buying a call spread and selling versus selling a put spread. So we basically tested 3 strategies: long call, selling a put spread, buying a call spread. That's for the bullish case, and for the bearish case, exactly the opposite. And back then, there was really no way of testing this stuff other than by hand. So we literally split up the time between a bunch of us, and each of us took a segment of time by hand, looking at end-of-day data with the options and putting them in a spreadsheet. And then we cross-check each other's works by, each person taking somebody else's work and double-checking it, make sure there was no data entry errors and things like that.
So when you were doing this, you said, all right, we'll do a put spread and we'll buy a call. Were you looking to say, all right, we're going to buy a call at a certain delta? Or did you try multiple deltas?
No, again, because everything was by hand, right? There was not a lot of trying we could do. We just had to pick one thing and go with it. So for the call, it was buying the first strike in the money 30-day call. So going about 30 days out, and the first option that at least had 30 days out, and buying the first strike in the money.
Okay.
And the reverse of that for puts. Basically, same rules for puts.
Okay. And then when you did the spreads, were those like at the money or just in the money, or?
The put spreads were slightly out of the money, and the
Okay.
call spreads were also slightly out of the money. So the call spreads were positioned a little bit, if going bullish, a little bit above the market, and the put spreads were a little bit below. So we're basically interested in testing the, is it better to be selling puts and put spreads below? Is it better to buying call spreads above? Or is it just better just to simplify the whole thing and just buy calls?
Okay.
So that was the question we were trying to answer.
And I have another slide here that looks similar to this one. You want me to flip to that?
Sure.
Okay. Oh, this is the SPY shares.
That's the SPY shares.
Okay.
And I think the one you were looking at before that. Okay, so this is the put call, right? Okay. So, yeah.
So I guess what did you find when you did all this work? This is fascinating. Like I rarely come across people that have back tested manually like this.
Yeah.
Right. And there's something to be said for being able to do it. Like you can nowadays, it's easy to just throw in some parameters and optimize on them, and see what the computer spits out. Let me test every indicator, and run parameters on them, and what's the best indicator, right? You can run all kinds of stuff really fast, right, which lends a lot towards over optimization. When you're actually going in and doing stuff like this by hand, you can really see nuances, and you can see, this is something that maybe was just an unlucky thing or a very lucky thing, or if we change this parameter a little bit, it would change the results a lot. But doing stuff by hand is, I think anyone that has the time can learn a lot by doing that. So. Sorry, I kind of went off track there.
No, I 100% agree. In fact, I recommend that to my students, saying that even if you're running systems, you always want to go in there and do things by hand, because you get a different perspective and a good feel for the system, the strategy.
Right, and look at all the trades, right? Yeah. Don't just look at entry and exit. Oh, this one made $3, but look at the chart and see how it made $3, and right? Yeah.
Yeah. See, the thing is, when you look at a graph like this, you just see the big picture. You go, wow, I would love to trade this, right?
Right. That only goes up.
Yeah, it only rises. What they're missing is if you actually zoom in to the left part of the screen, you see that in 2005, the system was, at least early on, was flat. So you had winners and losers and winners and losers, and they were mostly offsetting one another. So I remember the person that was helping us with the test, he took 2005, and as he was going through it, says, well, this system sucks. It doesn't work. And we're like, well, let's just finish our study, And somebody else would say, no, it's, I picked 2008, and it's working great.
Right.
So those are the kind of things you miss when you just click a button and run a back test and look at a 10-year result, and then you go, oh, okay, I'm going to trade this. You miss all the little wiggles.
Yep.
Yeah.
All right, so I'm sure everyone's dying to know, since I took it all off track. What did you find out?
Well, we were very happy to see that options do translate to directional trades, do translate well. So if you have a good stock system, that gives you a good entry and exit rules. If you turn around and trade an efficient product, and I want to emphasize that, this may not translate well to the stock XYZ that barely trades any options. I would want to pick a stock that's highly liquid, very efficient in the option pricing. The buying, even buying is slightly in the money, call, which has a lot of time value. So the option sellers would tell you that's a sin. Don't buy options because they decay, and like we said, if volatility goes down as the stock goes up, you're going to lose money. No, in reality, it works. It makes money. Now, if we did find out a couple of interesting things, if the volatility is exceptionally high and you're buying calls or puts, you're probably not going to perform as well, especially if your hold period turns out being a little bit longer than a few days. Now, keep in mind we were buying 30-day options, and our average hold period, as you noted, was around a week or so. So we had plenty of time. But even with that, we saw that if the volatility is exceptionally high, it might make sense to switch over to something like selling put spreads, at least for this time zone and that time period we traded. But the other big surprise to us was that selling vertical spreads or buying vertical spreads produced about 1/10 the profit of what just outright buying calls and puts did.
1/10?
So 1/10.
Wow.
So right now you're seeing about a theoretical $18,000 profit with this trade. The vertical spreads were maybe around maybe a little bit more than a tenth, but it was more like 2,000-3,000, something like that.
But the curve looks similar.
The curve looked very, very similar, right? The curve looked very, very similar, but just the profits were much smaller.
Okay.
And then at first glance, you're like, why? Why is the vertical spread making so much less money? But then the answer was clear. It was delta. When you're buying a at-the-money call or slightly in the money call, you're getting around 50 to 55 or 60 deltas. So for every $1 move in the stock, you're participating in about 60% of that move. But if you're trading a vertical spread, you have a lot less delta, and therefore you're going to be profitable. You're just not going to make anywhere near the money because your delta, instead of being 70, 80, might be 10, 15.
Okay.
So then we said, what if we adjusted for delta, meaning that increase the position size of the put spreads and the call spreads such that we're getting roughly around the same delta. And I had to do some, we didn't want to go back and retest 10 years worth of data, but what I did was took some sampling of what was the average deltas of these put spreads and call spreads, and just through the spreadsheet increased the size. Sampling some averages, and it turns out that if you normalize the delta, you're going to get roughly around the same P&L.
Oh, all right. So instead of buying one call and comparing that to one put spread, you would do 4 or 5 put spreads for
4 or 5 or 8 or 9, right?
Okay.
Just to get equal. Now I know some of the stuff we're just talking out loud. There is a report I have that folks can download. At the end of this, we can give them a link, and it kind of describes what I'm telling you right now in a lot more detail with graphics and back tests and things like that.
I was, excuse me, I got a cough. I was going to mention that, and I highly recommend everybody to go and download that. I looked at it last night. I read through it, and it's great. So just like Ali says, it's looking at backed to data and showing you where you're most likely going to be best off. So can I ask you about? Oh, geez, sorry. Can I ask you about the time to expiration again? Because you mentioned that these trades are about a week, and you bought calls, let's say if it's a pullback and you're going long, that are a month out. And in 2010, that's pretty much your only choice. But these days, there's, for many things, options are, weekly. For indices, they're like 3 or 4 days a week, and they're going to be 5 soon, I think. So people have the option to shorten that. Do you recommend shortening it? Do you recommend, like, how do you feel about, hey, I got a trade, I think it's going to be profitable 5 days from now? A lot of the stuff I run at Quantifiable Edges, I'll run a study and it'll show, over the next 3, 4, 5 days, we got a 70% chance we're going to be higher, and we might be up 1% or whatever. So
right.
How might you look to translate that into an option trade, I guess is the question.
Right. So there is a trade-off there. If you go, based on my experience, both trading and testing, if you go with shorter term options, you're going to get higher degree of volatility in your P&L. So when you're right, you're going to make more money on risk. And if you're wrong, you're going to lose more. And also when you're dealing with short term options, you're now starting to inject more of the effects of volatility and time decay into the equation. Remember earlier, we said there's 3 main components that go into it: direction, volatility, and time. And the closer we get to expiration, the bigger the effect the time is going to be. Now, the volatility itself isn't going to be a huge impactful when you get closer to expiration. Actually, volatility affects longer data options more. But there is a thing called gamma, which is the second derivative of it's a kind of a delta being a measure of how does the option change per 1 point stock move. Gamma is how much does the delta change for 1 point move in the stock. So what happens when you trade very near-term options, like 1 week out or with few days out, you have a very high gamma, which means you could buy a dollar option, and in half a day or a day, that dollar option could be worth $4. So you get a huge return. Or the dollar option can evaporate very quickly if it goes against you. So bottom line ends up being is that if you want to isolate the effect, if you want to just focus on direction, saying, look, my purpose in trading options instead of stock is to limit risk. So in case of a major crash or some big event, I want to know exactly what am I going to lose. Then to minimize the effect of gamma and theta, you want to go a little bit further out in time. And my rule of thumb is take my average trade duration. So if I think I'm going to be in the trade for 5 days, and multiply it by anywhere from 2 to 4 even. So minimum 10 days, or looking at 1 month out, even if I'm going to be in the trade for about 5, 6, 7 days.
Okay. So the nice thing with all the weeklies these days is that you can say I want to be 4 weeks out. You don't have to. It doesn't have to be. Oh, I got to be either 2 weeks or a month and a half.
Yes. The one thing I would be careful with the weeklies is if you're trading something like SPY, the Qs, or some of the very liquid stocks, you're fine. There's plenty of liquidity in those weekly options. Some stocks have very bad liquidity with some of the weeklies. So what I would do is pay attention to open interest and the bid-ask spread in the options that I'm trading. And if there seems to be a very wide bid-ask, or there's not much open interest, I would not trade the weeklies, and I would just look for the monthly option, whatever has a little bit more time.
Okay. I think you got a couple slides here where we touched on this a little bit already, but this is a long call strategy where you're saying we were looking for a pretty a pop in the stock pretty soon, or the security, and you're using options instead of potentially using a stop.
Right.
Right. Okay.
So if I'm expecting a move fairly quickly, and my primary goal is to limit risk without using stops, and a lot of the mean reversion trades don't work well if you apply stops to them, because the more oversold you get, as Rob points out in many of the studies that he runs, the bigger the edge gets. Now, that may not be true in every case, but if that happens to be the case where you don't necessarily want to use a stop, then buying an in-the-money call would give you a fairly good substitute for the stock.
Yeah.
And buying something with a little bit higher deltas, it's going to cost more, but what's going to happen is that because it's in the money, it has a little bit less time value, so it is a little bit less impacted by time decay, and it's a little bit less impacted by volatility, and has a bit of a higher delta. So which means that if you do get a quick bounce, you do get to participate in about, let's say, 65 to 85% of the move, assuming you pick those deltas of 65 to 85, and it's a range. If I'm a little bit more bullish and want more bigger kick, maybe I go with the 80, 85. If I want to be a little bit more conservative in terms of risk, I might pick 65. It's just a trade-off.
Okay.
And then it's just basically making sure I have enough time. That's why I have the guideline of 2 to 4 times the expected trade duration.
Right. If it goes your way, that's normally, that'll sometimes, if it goes your way right away, then great, you're making money, right? But if it continues to go against you for a while, it may take some time to bounce back to where you're hoping.
Yes. And if it's going against you, there's another thing that's happening. Your deltas are shrinking too. So you may start out with a delta of 80, and if the stock keeps going against you, the delta is going to start decreasing from, let's say, 80 to 75 to 70 to 60, etc. So, but that's the trade-off that we have, right? We said we want to define risk. We want to have something that if a market completely crashes, we don't lose much. So the position here naturally will almost like scale you out of the position as it's going against you, and would scale you into the position as if it's going for you. So it's a bit complementary to the whole notion of mean reversion, where you want to increase position if the market's going down and decrease it if it's going up. So it's a kind of playing a little bit of an opposite game to that.
Right.
Now, we could always scale in, right? We could always say that I'm going to start with a smaller position. If it goes against me, I'm going to add to it. Or we could do things, say that, well, I started with a delta of 80, now it's only 60, but I really think the bounce is coming from here. I have a bigger edge, so I may close that position and move back to a delta 80 again. So we could do that. We're adding risk at that point, but if the bounce does happen, we get to participate.
Okay. And I guess a positive that I've thought about sometimes is, if it goes against you and the delta is going down, well, now if you get an even larger acceleration, you're not going to get hurt as badly by it, right?
Exactly. The paradox of buying the dip is that the highest probability of a crash is where there's an oversold condition, right? Where you have multiple down days in a row, we were expecting a bounce, and now the market is really oversold, and that happens to have not only a high probability of a strong bounce, but at the same time, a high probability of a real crash happening at that time, right?
Right.
So having a position like this will give you that level of safety.
Yeah. I could go on and on about using stops, but I'm going to avoid that for now. And people can talk to me about that some other time. We've been going for quite a while now. I think I should probably take a outside questions because I've been peppering you with all my own. Is that all right?
Yeah.
Okay.
That's fine.
All right. Let's actually let me let you talk a little bit about how you trade. So we're talking here mostly about short-term directional stuff, but as you mentioned, you do a lot more than that. And so I don't know if you want to just touch on it a little bit, but for people that are looking to get into more complex strategies, calendars and diagonal spreads and things like that, you do all those things as well, correct?
Yeah, I do. And again, the report talks about that a bit, what some of the trades that I do. So I'm primarily focused on SPX, and then also trade SPY and the Qs and IWM and a few stocks as well.
Are they the highly liquid stocks?
Very highly liquid, exactly.
Okay.
I stay away from low liquidity because it just doesn't translate well to option trades. You get burned on the way out, and you get unfavorable fills, so they're not worth playing with. So yeah, I'm not necessarily doing very complicated trade structures where I used to, like I mentioned, years ago I used to do things with 8 legs and 12 legs. My trades may look complicated, but they're really not. Most of them are made up of either time spreads, like calendar spreads and diagonals, which have 2 legs, or butterflies, which have 3 legs. But one of the things I do is layer them over time and over different strikes. So, and I also trade in different time frames. I have positions that are longer term, what I consider long term, which to me is measured in months, versus medium term, which is measured in weeks, versus short term, which is measured in days. Okay. So I trade multiple time frames, and I trade different strategies, up, down, and sideways. I find that this type of diversification works very well for me. Instead of trying to diversify in different asset classes or stocks, I find it that, for instance, I might be short-term bearish in the SPY, but long-term bullish. And I could have both trades work. And I could have the short-term trade be a nice hedge against my bullish trade. So because they're in different expirations, they end up working fairly well for me. And and also this gives me the ability to sort of kind of focus on a few underlines and get to know their personality really well versus having to put money into 30, 40 different stocks, which I don't know too much about. Right. And not get into the trouble of, for instance, saying, okay, I'm long the energies because they're going up, and I'm short the NASDAQ because it's going down, so I think I'm diversified, but in reality I'm not. If a good news hits the market, the oil's going to sell off and NASDAQ's going to bounce, right? So I'll take a hit on both sides. Right. But playing both long and short and sideways in SPY or the Qs will give me a lot better level of safety.
Okay. Yeah, interesting. It's a nice way to think about it. Let me flip to the slide where it shows where people can download stuff, and then we already have a few questions in the chat, so we'll ask a couple of them. But this is Ali's site, and that's the download link to go get the options in practice. It's a little, not little. It's a guide you wrote, or what do you want to call it? A research project.
Yeah, it's a report. It's about 25 pages. It goes through, describes some of the concepts we talked about. There's a couple of interesting things we haven't mentioned here that most people don't know, don't realize, I guess, about concept of volatility and options that I talk about with some back-tested data. And also at the end of it, I'll show you guys some examples of some of the trades that I do. If you are clicking that link or typing it in, make sure the letters Q and E at the end have to be uppercase. Otherwise, you're going to get a blank page. So it's optionsinpractice.com/QE. Just go ahead and go to that page, and it shows you how to download the. Just type in your name and email, and then I'll email you the download link. Or if you have any questions, you can email me at that address.
Okay. Well, I recommend everyone that's listening to this that has any interest to go ahead and do that. It's a great little guide he wrote up, or a report, sorry. So Spoof Trader is asking, he says he's very beginner to options, and he's always wondered, what's the thing that you actually trade on the underlying? For instance, are you doing breakouts and just use options for risk management, or is there some trade that's specific to options that you might not do without options? So we didn't talk about breakout trading. Do you use options for breakout type strategies, Ali?
Yes. We're not in a kind of a market environment where a lot of the breakouts are working, but yes, I do use it. I do construct the options, and again, the trade structures in such a way that if the breakout fails, that my risk is relatively small. So, but yeah, short answer is yeah, I do trade breakouts as well as buying dips.
Okay. Yeah, because most of what we were talking about is dip buying thoughts.
Yeah. Oh, in fact, the document has one trade example in gold that I did that's buying strength. And this is both are recent examples, and the other one is a dip buying in SPY, so you get to see examples of both.
Yes. Okay. I should have recalled that. But yeah, there was a breakout example in that report, right, with the gold.
And I think the second part of the question was, or is there some trades that in specific that I might not do without options? To be honest, I don't trade anything that doesn't have options on it because of my early experience. No, that's not true. I do buy some close-end funds, kind of like a buy and hold type of thing. But
yep.
I'm always position sizing where even if everything goes to zero or close to it, I'm not taking a big hit. But as far as active investing and trading, or the bulk of my money goes into things that only have options, because that's the safest way I can manage my risk, given my experience of how market treated me in my early years.
And how it will treat almost everybody at some point if they don't manage risk.
Yeah, you trade long enough, you'll get to see some things you never thought you would.
Yep. Looks like you got a fan here with Brad. He says, having seen how Ali trades, he builds trade structures that you can't build with stocks in general. So that's nice of him to say. Vincent's asking, what percentage of trades are delta neutral versus directional that you do personally, I guess?
Oh, great question. So what I typically do is I and some of this may I don't want to confuse some folks, but bulk of my positions have a slight lean to them in terms of delta lean. I do delta neutral trades, meaning trades that have a relatively neutral delta, but that's if my expectations is for the market to be sideways. So for instance, right now, I am relatively neutral in SPX, and I'm not a big fan of people always doing delta neutral all the time, but I'm thinking sideways is also a direction. And if things are ripping to the upside or the downside, it may not make sense to put delta neutral trades on, but right now it does. So that percentage changes for me. In a typical what I would call a medium-term uptrend, I'm leaning long within a limit. So I have an upper bound on my delta of my portfolio that I don't go beyond. And in in a downward market or a more of a bearish lean to the market, I'm either overall neutral or slightly bullish or slightly bearish. So I'm adjusting the portfolio, or what's called the beta weighted portfolio of my positions, to what the current market condition is. And things that don't correlate well or do their own thing, like the GLD positions or right now energy, I don't include them in my overall portfolio delta calculation. I kind of take those out, treat them independently, so because they could do their own thing.
Okay. And yeah, it's interesting what you said about delta neutral trades. Like, they're great in some environments, other environments they're not. You hear from, you'll find some places on the internet where people are saying, you can sell volatility all the time, right? And just take a delta 20 below and above and sell it, and you'll be making money every day. And it doesn't quite work that way. You might make money most days and you get killed, right?
Yeah, I know of a site that promotes doing only that type of a trade, and I know some friend of mine and some other people that I knew that were following their methodology, and some people lost quite a bit of money during the COVID crash. So doing that, and there's one firm out there that's no longer in business that was trading people's money, sort of selling these naked options out of the money on commodities, and they got blown out during a natural gas rally that went against them, and they lost all their client money and then some. So their client owed money, and they closed shop. So to me, risk management is number one. And this idea of some people promote that trading these out of the money options is like income and
right.
and things like that. It's just very dangerous, very dangerous.
Works great till it doesn't.
Exactly.
Right. All right, we got a few more questions here. Ron's asking, are you trading mechanical systems versus more discretionary? And if so, what kind?
Yeah, that's a great question. So I describe my style of trading as a hybrid. So I'm not algorithmic in terms of every signal entry and exit is based on some quantified system. So what I do is I run systems and back tests to see if there's a bullish edge, bearish edge, or otherwise, and then I add some discretion to it with my trades. So and that's done in two ways. One element of discretion that's entered into the equation is the exact strikes that I end up picking. So if I want to, for instance, enter a calendar spread or a butterfly spread, I'm very cognizant of where a price action has been in terms of your potential support resistance levels, and I'm placing it outside of or around those areas, which makes sense. So, and the mechanical systems that I've tested with options have that leeway in them. In other words, if I have to pick exactly this delta for my option trade when this technical signal occurs, and if I pick slightly outside of that range and the system breaks, then it's a garbage system. I throw it out. Every system that I deploy, I want to make sure that it works within what I would call a delta range. So then I can use some discretion saying, well, my system is difficult. I can't program in all these support resistance and all this stuff, so I'm kind of giving myself some room for that. So, that's one type of discretion that gets entered into my decision-making process. And so the answer is a combination of both.
Okay. Which kind of leads into Dave's question here is, what technical analysis, if any, do you use? Obviously, support and resistance you look at, right? Are there other technical indicators, I guess, that you use?
As far as the technical indicators that I use are, I run some systems based on RSI, different time frames, okay, and also different periods RSI, I should say, and also moving averages, as well as Bollinger Bands. So I have some other indicators that I use quite a bit, and I've done quite a bit of back testing with them. But like, for instance, the DMI and the ADX is my other favorite indicator. But the main ones that I use are moving averages, Bollinger Bands, RSI, and ADX.
Okay. Looks like Judy tried to download it. She says, when we click submit, should I get any response?
After you put in your name and email, Judy, if you get a thank you page, right after that, it means that you were sent an email, and that email you received should have a download link on there. Okay. So,
and if not, she can email you at the email address right there, correct?
Yeah, or if you don't get that, just email me and I'll send it to you.
Okay. What back testing softwares do you use, is being asked by me too there.
Okay. So for back testing the equities, I use AmiBroker, but that's just to test different ideas on the underlying. And it doesn't do much with options, right? So for options, I use it's a web-based product called eDelta Pro, and it has very rudimentary technical filters. So there's not much you could do in terms of putting in all sorts of sophisticated entry and exit systems there, but if you have a general idea, I mean, it has a couple of things like moving averages and RSI. So those are the two products that I use for back testing: AmiBroker and eDelta Pro.
Okay, I use AmiBroker also, and I like it a lot. It's very powerful. Last question here, and then I got two last ones for you, and then we'll be done. Is your directional view over different time frames short-term, medium-term, and long-term driven by TA indicators alone?
Yes. It's primarily based, no, I shouldn't say 100% based on technical indicators alone. I would say 80 to 90% it's technical. The remaining 10-20%, I'm looking at various kind of sentiment indicators for the market, and looking for things that have shown edge in the past in terms of whether there's extreme bullishness or bearishness. So that's another area with a bit of a discretion will enter into my decision-making process.
Okay. All right, one more question here. It looks like from Spooz Trader is, what's a good beginner strategy based on the underlying the option strategy that goes with it? Something that's not very profitable but easy to start with and gives a learning experience and confidence. Would you say just some simple options trades like call buying and put buying, or some spreads, or what would you think there?
Yeah, just to because if you buy, I would normally say buy a call or a put, but I would not actually, believe it or not, would not recommend. First of all, I'm not recommending anything.
Right.
But if I were to recommend to myself, to my younger self, for how I would do things, it would be because straight up puts and calls have, again, exposure to time decay volatility more so. Yep. I would say I would focus on vertical spreads. So if I'm bullish, I would look to learn about buying a bull call spread, so buying a call and then selling a higher call against it, or selling a put spread. and vice versa if I'm bearish, selling a call spread, buying a put spread. So what's called vertical spreads, those are that would be the option structure I would focus on as a beginner.
Yeah, I've done a lot of that over time myself, and it's an easy way to define risk, and it's not very complex if you're just looking at a simple, selling a put spread or buying a call spread or whatever it is.
Yeah, it's very straightforward, and it's easy to execute, and it doesn't exhibit a lot of volatility after you enter it.
Okay, so last two questions here. Options in practice. Why'd you come up with that name?
Great, good question. Over the years, and I've always wished when I started out there was not as much educational material as there is right now. Right now, everybody and their nephew is on YouTube making, investment videos, right? And I listen to some of it. Some of them don't even understand the terminology well enough. They're talking about buying a credit spread, for instance. You don't buy a credit spread. You sell a vertical or sell a credit spread, right, to open. So and there's also just a lot of theory in options. So there's that group where they're just unfortunately giving a lot of bad information. And then there's a group of people that get so involved in the theory of options where everything is theoretical. Yep. And, if you sell this option, it means you have this much of a probability of success and, it's going to turn this way and that way. And in theory, this and in theory, that versus what I have found out is some of that theoretical stuff is true, but some of it is wrong. It just doesn't work, or it only works in a specific market condition. And some of these lessons I've learned the hard way. So the whole concept behind the name Options in Practice is what does exactly work? And it goes a little bit beyond that. For instance, if I can show you the best strategy on earth that has the most beautiful equity curve, but you can't trade it because it's just too uncomfortable psychologically or has to take big risks to do it, it's worthless. Right. So the whole concept of options in practice involves both things that work and things that could work for individuals because of their risk-averse nature or their comfort level. So that's where the name comes from. What works for individuals.
Okay. All right. I like it. And last question here I got for you is what would you say is I know you've read a lot. What's your favorite investment book? Doesn't have to be an options book, and I guess you could pick two if you want to. But
okay,
what would you recommend people look at or read?
Okay. Well, I did read a lot of books early on in my trading, and there were not a lot of option books back then. I would say if I had to pick one, it would be a book by John Bollinger called Bollinger on Bollinger Bands.
Yep.
It's
I got
very
that one.
nice.
It's a good one.
Yeah, it is a very good one. And I have been a fan of that indicator ever since, and I use it many ways. And so I would say it doesn't have a lot of incredible trading systems, but the concepts he defines there I think are very good and practical. And I also enjoyed the books by Alexander Elder, Trading for a Living. I just recall initially with my technical trading, I was not doing a good job, and after reading his book and the concept of multiple time frames and having what he calls the triple screen system and bringing in money management psychology into the equation was very helpful for me.
All right. Good recommendations. I like it. Ali, I've kept you quite a long time here, but I think everyone that's listened has probably gotten an awful lot from it, so thank you. This has been a lot of fun.
It's been a pleasure, and I had a lot of fun too, Rob, and thanks for hosting this. And if anyone has any questions, just send me an email.
Okay, and you can, Ali, are you on Twitter?
No, I'm not.
Yeah.
To be honest with you, I've stayed away from social media, but
okay,
I can
so
never
email's the
predict
best way
the
to get you.
future. Yeah, email is the best way to get me. Yeah.
Okay. All right. Thank you. Thanks everyone for attending, and that's it for today.
All right.